2011 is in the history books, and it was a good one for the U.S. apartment industry. And that came even though the overall U.S. economy continued to look pretty lackluster. Apartment occupancy climbed above its long-term historic average, and in most areas, rent growth came in at levels that made many apartment owners and operators very happy. So, what's going to happen in 2012? That's what we're going to look at today. I'm Jay Parsons. He is Greg Willett. Baby New Year. And Greg, what's the big headline for 2012? Will apartment revenue growth levels, I should say, top the levels that we've seen in 2011?
Well, Jay, our overall number for revenue growth in 2012 is a tiny bit below the 2011 number, but still a really good story and essentially more of the same. But we will take a little bit different route to get there from what we saw in 2011. So let's jump through some of the stories there, talk about what's happening with demand, supply, occupancy, and rents. And we'll start with the demand story. And two key influences to look at there, one being what's going to happen with the job market. And again, it goes back to that theme of more of the same. What most forecasters have predicted for 2011 on job growth in the individual markets, pretty much in line with what happened in 2011. I will point out the markets that had been trailing and were still in slightly negative territory in 2011 probably go to slightly positive numbers in 2012, but not a lot of big shifts in overall momentum. The other factor to look at, what happens with the other housing product out there that would be choices other than apartments. And the key story there is we think that low loss of renters to purchase continues pretty much everywhere. Could be a few exceptions, and that's primarily the Texas markets. Now, we did see in the Lone Star State home sales start to move up in the last half of 2011. There's the potential for pretty strong increases in momentum in sales in Texas during 2012, but these will be the country's employment growth leaders, so still lots of room for demand for apartments in the Texas markets. And importantly, those demand numbers look pretty good compared to the completion numbers, which you're going to talk about a little bit.
Yeah, let's look at supply. And it is interesting to see new development is kicking up again. But for the most part, what we're seeing are new starts or projects that haven't even gotten that far, some announcements that haven't yet translated into groundbreakings. And so what that means for 2012 is that new supply levels won't be much higher than what we saw in 2011 in most spots, until maybe the second half of the year for some areas. Now, there are some exceptions, of course, and that starts with places like Washington, D.C. and Dallas, where we continue to see a good bit of construction. And another one that might surprise some people is Orange County, a good bit of construction going on there as well that's yet to complete. But even in those metros, we're looking at delivery totals that are less than the historical norms there. And so we certainly aren't back to the levels that we saw in 2008, 2009, those peak numbers in metros like that. And so there's probably no place where supply in 2012 looks likely to outstrip the absorption levels by a significant margin.
So, Jay, a good supply-demand relationship there in most markets. So we're talking about occupancy that's stable to slightly up in most places?
Yeah, our expectation is occupancy is going to continue to improve. We're looking for occupancy growth of about a 0.5 percentage point in 2012. Most of that growth, we think, is going to come in those Class B and Class C properties, and that's largely because, first of all, the top end of the market is largely full at this point, and second of all, it's also a function of the economy to some degree. Those middle and lower tiers at this point are the more affordable housing options. They're what most households can afford at this point after we've had 2 or 3 years of significant rent growth, and at the same time, we've seen little wage growth, so most of that demand should be shifting to those B and C grade properties. So, Greg, there's the occupancy outlook. What's that going to mean for rent levels, rent growth in 2012?
So, Jay, our forecast for rent growth in 2012 is 4 to 4.5%. Tiny bit below the 2011 number, but still certainly good stats overall. And as you mentioned, affordability does start to come in play in some markets as we're looking at these numbers. And particularly for properties that are already full, operators are at the point where they have to make a choice. Do they want to continue to push rents pretty aggressively, which could lead to some higher turnover from what we've seen in the past couple of years? Or they really think it's important to hold on to their existing residents right now. And as we look at some stats that we've gone back through and look at transaction level data, what we're seeing is that the discount for a renewal lease versus a new resident lease is getting bigger and bigger and bigger. And so resident retention, generally a good thing, but maybe you can push that too far if you're leaving some money on the table. And I'll point out that in a couple of weeks, we're going to have the NMHC Apartment Strategies Conference and annual meeting, and I'm going to be moderating a panel with apartment management professionals at that meeting, and that's going to be a key topic that we're going to talk about, is that relationship between renewals and trying to push rents versus hold on to the existing residents.
So, Greg, I know that when we're down in South Florida for that meeting, one of the things we're going to ask a lot about is individual markets. What markets are going to perform the best in 2012? So what metros are on your list?
Part of the story for 2012 is not quite as big a spread from the top to the bottom that we've seen over the past year. The ones that have been doing really well, we do think that they maybe slow down a little bit, and that does come back to that affordability point that we've hit several times in this video. On the other hand, some of the ones that have been laggards, occupancy is getting strong enough now that they should be getting a little bit more pricing power, so not necessarily a huge gap between the top and the bottom. Focusing in on some individual metros, San Francisco, which was the number one market in 2011, we still got it at the top in 2012, but we're probably looking at revenue growth somewhere in the 9 to 10% range versus about 15% seen in the past year. Next on the list, just a hair below that, we've got Austin. If San Francisco doesn't quite come through and meet expectations, Austin's the leading candidate to take that top spot. Other metros that where we expect to see high single-digit revenue growth, the other two Bay Area markets, so San Jose, Oakland, and then Boston would also be in that category. Going to metros where we think maybe the revenue growth will be around 6 to 7%, lead that off with New York and Denver, and then some surprises that are usually not on that top tier performers. We've got Dallas, Charlotte, and Houston coming in to finish up the top 10.
All right, so some surprises in there. But what that means is that a few metros maybe we expected in that top 10 won't be there anymore. So some I noticed that are missing Washington, D.C., Seattle, Portland, Chicago. There's no Florida metros in there, no Southern California markets in there. What's going on with those?
From our perspective, definitely no on D.C. and Seattle. Those are markets that we think will be performing about in line with the national average. Most of the Florida markets actually a little bit below the national average. Portland could sneak in there. It's right at the breaking point for making the top 10, as is Chicago, Minneapolis, Raleigh, so they could sneak in there. And then if there is a dark horse across the country, it's probably Los Angeles, and that is one that has done pretty well in the second half of the year. All the pieces of the puzzle don't quite fit at this point in that one, though, so we're not completely confident that the momentum is sustained. But if there's a surprise one that really moves up the ranks in 2012, probably LA.
Okay. So there you have it. That's what to watch for in 2012. Join us next time when Greg and I are going to be looking at the results from fourth quarter 2011. Did we continue that momentum that we saw in 2Q and 3Q? We're going to look at that in our next episode. So until then, for Apart Market Dynamics and MPF Research, and for Greg Willett, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.